In today's episode, we have a really special guest with us, Mr. Arn Cenedella. Arn, thank you so much for joining us.
Hey, Robert, thanks for the invite. Appreciate being here, and hopefully we can provide some value and good information to your listeners.
I know we can. And for all our listeners out there, I wanted to explain why Arn was a great guest and why I decided to bring him on the podcast here today. Now, Arn has over 40 years of experience in real estate. He's a seasoned investor. He's transitioned just a few years ago, as we'll talk about, from single family to multifamily investments. And he has his own investment group or syndication company called Spark Investment Group. And we'll talk a little about that as well. Now, the strategies and the topics that we're going to focus on with discussion with Arn is going to be investment strategies for real estate, some insights on the current housing market, and tips for both active real estate investors as well as passive investors that want to earn good returns without having all of the additional hoopla that come with owning real estate, right? And that's what Arn's going to shed some light on. So to kick off our episode, Arn, can you just take us way back? Beginnings for you in real estate. It's over 40 years ago. What inspired you to get into real estate? And how's your approach changed from then up until now?
Yeah, so great questions. And like most American middle class kids, my parents said, work hard at school, do well in school, go to college, get a degree. Did all that, ended up with a master's of science in chemistry of all things from the University of Michigan. Was born and raised in the San Francisco Bay Area. And after I got my degree, I wanted to return to the Bay Area. At one point, I thought I might want to be a professor or research scientist, but basically, it became clear to me that wasn't where my passion was. Wanted to return to the San Francisco Bay Area. My father, Hal, had a residential brokerage business in Menlo Park, California, which is basically Silicon Valley next to Palo Alto. And March 1978, got my license and started selling single-family homes.
So take us from then to now, your approach, because back then you were just selling real estate as a realtor, right? Real estate agent. Now you're running a syndication company. Obviously, you've matured a lot, but how's your actual approach to real estate really changed over the years, would you say?
Yeah, so my father was a big real estate investor himself, which is sometimes unusual. It's amazing to me how many brokers don't also invest in an asset that they should know. So I was a single family investor for 30 years. Back then in the 1980s, you could actually buy houses in the San Francisco Bay Area that could make sense as rentals. Of course, today that's not really the case. Ended up moving to Austin, Texas, moving my investment business to Austin, Texas about 2000. And I think most of your listeners understand Austin's been a pretty good market to go in. About 4 years ago, actually, when COVID started to hit, I decided to transition into multifamily. And I don't know so much that my investing philosophy changed because I think the fundamental principles are the same, and I'll cover them in a second. But rather, it was more scaling the investment business, kind of moving from single family to multifamily, still keeping in the residential space. It's not like I went from single family homes to office buildings or retail centers. It was in the residential space. And one of the reasons I moved to multifamily is, one, we know we have a housing affordability crisis here, and apartments and maybe mobile homes are the most affordable asset class for Americans to rent. There's a big demand for that. They're not really building affordable housing. So I just think long-term, kind of the demand-supply dynamics really work well for multifamily being an affordable option for people.
Was COVID was it? I should say it like this in 2020, right? We think back to 2020. The first couple months of the year were pretty much normal here in the U.S. up until about April, I think. I did some traveling myself, end of February, early March. Wasn't really that crazy. Was that shift before COVID or after, we have this pandemic and the quarantine? And that's a big question.
You're a mind reader, Robert. So actually, it was about mid-March. I had a call from a young investor friend. I now live in Greenville, South Carolina, and I've been here for about 10 years. Had a call middle of March 2020 from a young investor friend. And he called me up and he said, "Hey, Arn, what do you think's going to happen with rent collection?" And I said, "Well, Mario, I don't know. I've got my March rents already. Let's talk April 5th and I'll let you know how it goes." So it was right at that time, as you note, where we were starting to understand COVID was a big deal. We had heard inklings January, February, but it wasn't really to March or April. And at the end of that conversation, he turned me on to a podcast from about multifamily investing. And that kind of set a light bulb off in my mind. And I was kind of ready to make a transition. So with the multi affordability, you have some element of scale. It's nice to have 20, 30, 50 rental units, income producing units on the same property. It's a lot easier than having 20 or 30 homes across your county or community. So there's elements of scale. And then the other part with multifamily is it tends to be a team-oriented thing where typically single-family investing can kind of be a solitary experience, where with multifamily, it's typically groups of 3 or 4 people who kind of get together and each bring their specific skill sets to the team to create a really functional, dynamic investing team. And so now at Spark Investment Group, I have 2 partners. They fill in the gaps. They fill in the areas that I'm weak at. They allow me to do what I do best. And so that was another reason to kind of make the move to multifamily.
Okay. So I think the transition that you had from single family to multifamily, it sounds to me like it's almost the stereotypical transition that almost any real estate investor will have, right? So you're in the real estate business and you're selling one home at a time, one single family home at a time. And obviously, decades ago, affordability was a lot higher in San Francisco. I can imagine you were, like you said, looking to scale. You could only sell one house at a time. But multifamily, you can sell one project, one product, and that might be 5 times or what you would make on selling one single family home, right? And I think no matter what the numbers are, the math is really the same. I think even today, multifamily homes are, or multifamily real estate are a multiplier more valuable than a single family home, right? So it's going to take so many single family or 2 family houses to equal one multifamily deal. So I think a lot of people have that, whether you're selling real estate or you're just a real estate owner, right? A homeowner with one property going, how do I turn this into 10 properties? How do I turn this into 20 doors, right? Multifamily investments are definitely the way. And I think majority of real estate investors come to that point, right? Where they say, why am I doing this? I need to transition. So can you talk for just a second to all my investors out there that are having that thought right now? I need to get from single family and go to multifamily. It's not 2020. It's a different market right now. We talked about what motivated you, so I don't want to really delve into that, but more, what advice do you have to people right now in 2024 that are saying, I want to move to now multifamily investing?
Yes. And you can imagine, we all know managing one rental house is some work. At some point, I accumulated about 30 of them. And so the work was multiplied by 30. And so by going to multifamily, you can kind of minimize the work because there's kind of a rinse and repeat aspect to it. I would say if somebody wants to start to invest in multifamily, of course, the first kind of question is, do you want to own the property individually and kind of be actively involved in managing it? That's perfectly fine. Do you have the time, the capital, the knowledge, and the energy to be able to do that? Or do you want to invest passively through kind of syndication models? And that's what we do at Spark Investment Group, where we allow individuals to invest. And in our deals, you don't even have to be accredited. Right. We take sophisticated investors. Our investors get the benefit owning real estate without, let's say, the headaches or the drama, as you alluded to, of owning rental properties. So that's kind of what we do. If you want to be active, I would say select a market and really drill down into that market. Get to know the brokers and the property managers and the lenders that deal in that market. Don't try to learn 10 markets. Take one or two markets and really get to know them. Start looking at every property, tour every property, get to know the market, and hopefully you'll find one that works. As a passive investor, what you're really maybe first looking for is finding operators, sponsors, general partners, that's what I do, who maybe one, do deals in a market you like. I'm in the Southeast. I love the Southeast, but people love the Midwest now is very hot. Kansas City's hot. Florida's big. Texas, Boise, Idaho, the Mountain West, Arizona. So there are a lot of good markets. So try to ascertain what markets interest you and then find operators who work in that market. Generally, podcasts are a great way to make connections with operators. You can also get on social media. Now, Spark Investment Group, we primarily do so-called 506B syndications, which are available to accredited and sophisticated, but we cannot advertise specific investment opportunities. So you need to make a connection with the operator, and as the relationship develops, you will then be presented opportunities. So I think those are the two tracks people can consider. Both are wonderful. I think it's just a matter of how much time, energy, and capital one has.
Yeah, no, I agree. There's a couple things I want to hone in on from what you said. The first thing is that as a real estate investor, you have options. You can choose whether you want to be an active or passive investor. And I think when I started out delving into multifamily and commercial, I didn't realize that there's a syndication option. I didn't realize that I could get involved in some of these deals with, depending on the scenario, like $10,000, $20,000, $50,000, right? I mean, these are amounts you couldn't even put a down payment on a lot of these multifamily deals with that, let alone get involved in the deal, right? And because of syndication, the stuff that Arn's talking about, it just opens up this whole world. So I think if you're someone who's hearing about this syndication idea for the first time, hopefully this is a light bulb going off. This is something that went off for me in 2011, and I've now been able to build 7-figure portfolio of passive real estate because of it. And the other thing I want to point out is the geographic locality of real estate. It's so important, right? It's all about location. And any realtor or real estate pro is going to tell you, like, to manage buildings and do deals from halfway across the country, it's not impossible, but it is difficult. And the syndication aspect takes that all away because you're invested in deals anywhere. I mean, I'm invested in deals in California, Idaho, Utah, Texas, Florida. I haven't been to these properties once, yet they're depositing money in my bank account every month, every quarter. And it's really a cool concept because, again, I always was thinking, well, you got to have, a 7-figure check to get involved in those deals. Or you have to write just a large check, $150,000. That gets rid of almost anybody out there, right, that wants to start out. But to my investors out there, when you start delving into this and realize there's syndication opportunities, like I said, with really low investment amounts, and you could take the 20, 30, 50 grand you were going to put into a deal and get that into multiple deals. In real estate, diversification is just as important as it is in the stock market. And it's almost impossible to do without taking on the strategy like syndication. So I'm passionate about it. I've used it. You do it every day, Arn. Obviously, you've built a company doing it. But I think that, to piggyback on what you said, as an investor, you need to figure out what path are you going to go on, active or passive. And if it's active, then you need to be very niche down in a geographic area. As Arn said, don't try to be a jack of all trades and invest anywhere that's hot. No, find an area near you, get really familiar with it, know the players, meet the agent, get the lending relationship, build that foundation, and then you can move forward confidently. And if you don't want to mess with any of that, then do syndication. Because again, that's what I've done. I just didn't want to deal with that day to day anymore. Syndication solves all that. So that's why I'm so passionate about it. To my real estate investors that are just starting out, when they're trying to focus on, like, what should I be looking for in an investment in multifamily? Me personally, I focused always on cash flow. I looked at the deal as if there was going to be no appreciation. And because of that, I was able to vet strong deals. So what do you say as a multifamily expert, been involved in a lot of deals, cash flow versus appreciation right now? What are you looking for? What's the secret? What should investors be focused on?
Yeah, so that's a age-old debate in the real estate industry, and I'd submit there's maybe not one right answer because I think each investor is unique, and somebody who's 35 entering their peak career earning years is going to have different needs and desires, different risk-reward tolerances than somebody who's 60 years looking for the off-ramp. So cash flow is absolutely necessary. The way I look at it, when we buy a property, we invest a certain amount of capital into the property. From there on, day one, we want that property to be self-supporting. And basically what that means is the rent less all the operating expenses, taxes, insurance, repairs, property management, and less debt service produces a positive cash flow. So positive cash flow is absolutely necessary. And then from there, I think how you balance cash flow versus appreciation is kind of an individual choice. The other thing I would say is as a passive investor, you have the ability to diversify geographically with asset type. You could buy part of a new luxury Class A building in Dallas, Fort Worth. You could buy a workforce value add property in Phoenix, Arizona. You can diversify your money geographically with the type of property and so forth. I'll circle back to the local aspect because I do believe real estate's very local. We're in Greenville, South Carolina. We basically only do deals in the upstate of South Carolina. So I believe local knowledge is really good, really important. When you're looking at potential syndication opportunities, one of the things I would look at, in addition to cash flow and the return metrics, is who's the sponsor, who's the general partner team. The next question would be, are they a specialist in the type property that they're marketing to you now? So, for example, one could be a great operator in Dallas, Fort Worth with 1970 value add type property, and they already own 5 of those type properties in that market. So, as an investor, you would know they pretty much have the property management nailed. They probably have the renovation contractor nailed. They know that market. They own 5 buildings in the market. They're just buying another one. Is what they're offering you kind of what their specialty is? So if that operator then turned around and offered you a new Class A building in Charleston, South Carolina, I might pause a little bit because do you own anything else in Charleston, South Carolina? Do you own any other type properties like this? So look for sponsors that have that niche, that proven track record in that market with that type property. You really increase your probability of a successful investment by doing that.
No, that's a great point. And I think one of the biggest metrics of success, specifically on the real estate syndication side, is the sponsor. Because you could buy the best deal, get it under contract below market value, have a great plan. If the experience isn't there, if the team isn't there, because these are big projects, multiple people, different companies involved, it's all run by the sponsor. So for my novices out there in the syndication and crowdfunding space, the sponsor is the person who's putting the deal together and managing the deal, right? They are hiring, they are firing, they're vetting, they're doing everything, right? They're your boots on the ground. You need to make sure they're good, okay? And you can look them up. It's very easy when you start getting into this space. You're going to see who the sponsor is. You can go look them up yourself on Google. Do your own due diligence. I would echo everything you said. Geographically, are they in the area that you're buying? Do they have that local presence? And do they have the experience in the actual type of real estate? I've seen syndicators that'll be great at office and then they'll switch to multifamily and they'll bomb, right? It wasn't cohesive. They didn't have the experience. You can lessen your risk significantly by making sure that those 2 pieces of the puzzle are there, and that's it. If you don't do anything else and just make sure that sponsor is local and they have a lot of experience. When I say a lot, I mean at least 5 years to me, not less than that. The more, the better. Then you take away a lot of that. You de-risk your situation. And when we're talking about real estate syndication, we're also just are talking about real estate crowdfunding. Crowdfunding today online is the same way of syndication of the 70s and the 80s and the 1990s before the internet was around. So we're using those terms like interchangeably. With that being said, it's a volatile real estate market right now, especially in multifamily and in commercial in general. There's been a lot of ups and downs over the last couple of years. So with that being said, safety nets right now, de-risking right now. How can somebody invest in multifamily real estate, do what we're talking about, expand their portfolio, but do it safely during the times that we're in right now, which again, they're unprecedented.
Yes. So that's a great question. And we started our conversation about my investing principles and how have they changed. And what I would say is my investing principles haven't changed over time. I've changed the type property I invest in, but basically my father, who was born 1921, actually lived through the Depression. So there's somebody who understands a little bit of rain can fall and there can be problems. So my investing philosophy is one, I'm a big believer in fixed rate debt. I think that's one of the key benefits to real estate investing. You can get long-term fixed rate debt. Don't over leverage the property. That means put 35% down, even if you could buy it with 20, and maybe the returns would even be a little better with 20, but the risk goes up. Number 3 would be have ample cash reserves, because on occasion Murphy's Law strikes. You need to replace a HVAC system, put on a new roof, whatever, rents decrease a little bit. Have ample cash reserves, and then kind of know what you're doing, have some operational ability. In my experience, 46 years, the only time people have really got hurt in real estate is when they over leverage, they got adjustable rate debt, and their operations are weak. They then are faced with the situation where they can no longer afford to keep the property and are forced to sell in a down market. However, if you do it right and follow the principles I laid out, and the property's cash flowing, paying for itself, even if values go down a little bit, and certainly the last 18 to 24 months in multifamily been a little rough, the value of some of our assets have gone down. Are we worried? No. They're cash flowing. We're paying distributions to our investors. If you set it up right, you can ride through that year or two of turbulence. And then generally, in my experience, you kind of get 5 to 7 years of boom. Then there's a little correction, maybe a year of flat, and then you got another 5 or 7 years of boom. And so as long as you set it up properly, prudently, ride out the bad times, you'll benefit on the good times. And in my experience, the good times are always much larger than the little down times. You could have values run up 70, 100% over 5 to 7 years, and then maybe you have a 10% correction. You're still 90% to the good. It's a pretty foolproof way to go about it. So that's my investing philosophy. That's what we do. And I think if people approach it that way, they can successfully invest. The other part of it is it's a long-term gain. When I buy property, I'm thinking about what's it going to be 5 to 10 years from now? And am I going to look back and be glad I own it? I guess the follow-up question would be, can anybody make any logical, rational arguments to indicate the price of housing is going to be lower 10 years from now than it is today? I just don't see it. In my life experience, it hasn't happened, and I just don't see it. Cost of goods, labor, land is going up. Housing's going to get more expensive, so why not own some of an appreciating asset while it's cash flowing and paying for itself?
Yeah, no, that was a great answer there. I think to sum that up, it's really about creating the foundation. And if you have the right foundation, and you shouldn't waver on that foundation regardless of the market. And I think that's a big excellent point you made. So it's about fixed rate debt. Don't mess with the adjustable rate, hybrid, different loan products that come out. You stick with fixed rate debt. You can always refinance if rates go down in the future, but at least you know kind of your worst case scenario. That's huge. And the other thing you've said multiple times that I just keep reiterating is the cash flow, right? The cash flow taken care of and basically paying the expenses. So you're not in the negative. And then if you can refinance in the future, drop your debt service coverage, drop some of these other things or increase rent, well, now your return can just compound from there. But at least you know that foundational bottom line. And I agree with the fact that people that get in trouble in real estate, it's because of those items that you mentioned. And then they're forced to sell when it's not an opportune time to sell. And that creates big opportunity for real estate investors, like many of our listeners today. You busy professionals, parents, people that they have a life, they realize they can't take all this on, and they're looking towards syndication as a way to build a real estate portfolio, right? So can you talk about some of the benefits of syndication, specifically investing with Spark Investment Group, what you guys do? And I want to give that in the context of our listeners that are saying, hey, I want to passively invest in real estate. I don't have the time to find it, manage it, but I've got a bunch of money that I want to put to work. So give some context to that, investing with Spark Investment Group as a passive investor.
Yes, and I'll start with making general comments about Spark or any syndication outfit. First of all, we understand real estate does offer some significant tax benefits. The tax benefits of investing in syndication are identical to the tax benefits of owning real estate individually. Syndications are set up as pass-through entities. So any tax deduction the entity gets passed through to the limited partner investors. So the tax benefits are there. As the sponsor, we also sign on the loan. So as a limited partner investor in a syndication investment, you don't have any liability or responsibility for repayment of the loan. The general partners or the sponsors are the ones who are signing on the loan. We're taking personal responsibility for the loan. That's nice. It's limited liability. It's an LLC company and so forth. Spark Investment Group, we are generally very focused on Greenville County. Okay. We're kind of long-term investors. We actually like the sub 100 unit apartments. Many syndicators will say bigger is better, and why there are some arguments to do that. In our experience, getting these 30, 40, 50 unit properties, you get in, you turn them around, and you can get it done in a year or two, and now they're really operating well. Where I think with the larger ones, it often takes longer. So we like to kind of get in, get a property up and running, humming, cruising along, and then we go on to the next property. What else? Typically, we pay quarterly distributions, and typically our investors are going to get kind of a 6-7% annual cash on cash return. Overall returns are typically going to be about a 15% internal rate of return, about an 18% average annual return. The other thing I would say about our investing approach, we don't swing for the grand slam. We don't swing for the fences. We aim to hit line drive base hits. That's how I've invested for myself. That's how I was taught. We just keep hitting line drive base hits, make good returns. What does Warren Buffett say? Rule number 1, don't lose any money. Rule number 2, don't forget rule number 1. So our investing style is a little more conservative, solid line drive base hits, solid returns over time. I can say proudly, we've paid every distribution to our investors on time, in the amount promised or more. And this is at a time where many syndications, they're pausing distributions, or the operators are saying, hey, we underestimated the capital expense. Yep. You need to invest more money. Like Robert, I'm also an LP investor in probably about 10 syndication deals. It would drive me crazy if my operator came to me and said, hey, Arn, we're in trouble. You need to put more capital in. So that's kind of what we do. And,
it's set it and forget it, and that's what I love about it. For those that are looking for that, this could be a great addition to their portfolio. And I would incentivize everyone that's looking for diversification to work with multiple syndicators. Nobody's saying that you have to put all your eggs in the basket with Arn at Spark Investment Group, but I would look at it as, hey, maybe I do a deal or two with Arn at Spark, a little more conservative, a little bit more foundational, right? Not swinging for the fences. There are other syndicators out there where you can invest 25, 50, 100,000, and they will go and do development deals, repositioning deals, right? Where they're taking like a Class C property, doing a bunch of renovation, turning it into a Class A and increasing rents. That can take years. That can, entail a lot of risk, right? There's nothing wrong, though, with having that in your portfolio. One of the beauties of the syndication and passive real estate investing is that you can have all of this for the same price as you would buy one single family home. And let's not get away from that, because that's what continues today to attract me to the space. That's why I continue to do passive real estate investment. And I'm doing syndication instead of active investing. Okay. I found in crunching the numbers, as a lot of investors, when you really get down to the brass tacks, you're not making more money when you're directly investing versus having a sponsor, having a syndicator that does this whole deal. When all the smoke clears, if you're only ending up with a 15% return, then why do 15% working 10 hours a week when you could do that same return working 0 hours a week? Well, maybe going into your bank account and checking if they deposited your return every quarter or every month, right? I hate to misdirect people or say don't do direct real estate investment. I really don't like doing that because I'm a mortgage originator. I love helping people buy homes. And I agree, even to this day, you got to have a place to live. You got to have a place to put your head at night. You might as well own it, right? It's a good investment over the long term. But when we branch out from that and talk about multifamily, especially if you're new in real estate and you don't have a lot of experience, there's not many options that I can think of that are as attractive to get into multifamily, where I could literally get you in within the next 30 days. You could get into a deal. Syndication is what makes that possible. But getting away from that for a second, Arn, as we wrap up here our conversation, pitfalls. People say, no, I want to do this myself. I want to be a real estate investor. I want to do it directly. I'm going to go find my first building to buy. I've got the capital. I've got the motivation. I've read the books. What are some of the biggest mistakes you see with those first-time investors trying to delve into direct investing on their own?
Often they think it's easier than it really is. Screening tenants, finding suitable residents for your property. There's nothing worse than having to go through an eviction or dealing with a tenant who's destroying the property. Beginning investors often have a hard time figuring out a good system to properly screen tenants. And of course, on the other side, there are fair housing laws that you need to know and follow to understand in the leasing process. I think the other issue often is people underestimate what it's going to cost to do certain things, or underestimate cost of repairs and maintenance. And so they don't properly budget HVAC system going out 2 years after they buy the property, and that's a $10,000 bill. People who live in high-cost areas, like the Bay Area, you wouldn't really buy a single-family house in the Bay Area, so maybe they go to Kansas City, Kansas, or they go to Charlotte, North Carolina. Trust me, the other investors and the brokers in those areas kind of understand you don't really know the lay of that land and property. So I think another big mistake is buying in locations that you don't quite understand. And we all know in our own community, you could be on one side of a street and it's a fabulous area. Go on the other side of the street and it's not so fabulous. And so when you're 1,000 miles away and don't know that neighborhood, and you're looking at the map and you're trying to evaluate the comps, you don't really recognize that there's two different neighborhoods. This is all you know. They're a mile apart, so it must be the same. So I think not understanding those street by street, neighborhood by neighborhood variances within communities is another mistake first-time investors make. So those are a couple they should be aware of.
I've seen so many people, especially I'm up here in Connecticut in the Northeast. We have housing markets here that have rapidly appreciated recently after a long, long drought of stagnant returns for decades. But with that being said, some of the major metro areas around here in the Northeast, Boston, New York City, Philadelphia, right? There's certain locations you go and start looking at multifamily stuff around there and it's like, I don't think it can work, right? So then you branch out. And I've had so many that have said, no, I'm not going to invest in Connecticut. I'm not going to invest in New York. I'm looking at the Midwest, right? Everybody's looking at the Midwest. So many cheap properties, and cash on cash returns. There's all this stuff that's attractive. However, they leave out the fact that you're not local. And I've seen so many very astute investors, very smart people, and they crash and burn when it comes to investing out of state. I think a lot of that is the team that you have. Like we talked about sponsors, what team you're working with, the whole team, the real estate agents, the lender, the attorney, the title, like it's all part of your wealth team. You either vetted them or you didn't. And the more you go out of your locality to try to direct invest, I would just tell you it's not even worth it. I'd 100% be going syndication if you're trying to invest more than 100 miles away from where you are. I just don't think it's realistic. The risk is too high. And you could take that same capital as we're talking about and put that into multiple projects. Maybe that means 2, maybe that means 10, right? But it's diversification, it's de-risking. Timeless lessons. Go ahead, Arn.
Well, so the one thing I might jump in on to further educate the listeners about syndication is, as a general partner, we are compensated for running the deal. What I would say is almost all of our compensation is paid at the end of the deal and is directly proportional to how well the deal did. The better the deal does, the higher the compensation for the general partner. So the point there is the general partner is extremely motivated to run these deals profitably and increase the value because our compensation, our share of the profit is directly related to how well you do. And so it's a good alignment of interest. It's a performance-based compensation. If we double the value of that property and you get 100% return on your money in 4 years, we get well compensated, but you get really well compensated. So just so the listeners know, the back end, the compensation's back end.
I love that. I'll piggyback off that thought in saying that one of the metrics that I look at specifically when we're talking about syndication and the sponsor is, does the sponsor have their own money in the deal? If the answer is no, be weary. But I love looking at a syndication where the sponsor is putting up 10% of the capital needed, because that means their money is where my money is. That means we're on the same page. So I agree with that. And I think that's just an extra layer, de-risk, an extra layer of potential profitability and a good investment by making sure that your money is aligned with the sponsor's money or whoever you're working that deal with, right? So that's huge. So last question for you, Arn, as we're going a little over here, but all your time in the industry, residential, multifamily, all this, 1,100 units, 100 million plus, real estate portfolio, key lessons that you've learned, timeless things that were the same 10 years ago, 20 years ago as they are today, because people will be listening to this podcast in 2034 wondering, what are some timeless real estate investments, specifically multifamily tips for investors, whether they're active, passive, or anywhere in between?
Yeah, so I'm a big believer buying quality properties in quality locations. The numbers sometimes can look a little better on paper in some of the inferior locations, but I think what you may find with experience is those don't perform as well in real life as what you estimate. So to me, look for good properties, quality locations, invest for the long term. We've already kind of covered it. Low leverage, fixed rate debt. Yep. Let time, inflation, and population growth win the day for you. And so that's how I would go about it.
I love it. Simple and straightforward. And that's what it's all about, because people try to overcomplicate this. It's like multifamily real estate and real estate in general. It's not that complicated. Don't get greedy. I heard kind of that through your conversation with me. Real estate can provide a great source of income and a great source of appreciation. But if you get greedy, if you swing for the fences, if you make unrealistic assumptions, you can really hurt yourself and set yourself up for failure. So,
Correct.
I mean, it's been an absolute pleasure and an honor to have you on, Arn, today. I think our conversation opened up a lot of people's eyes, real estate syndication, as well as some of the pros and cons of direct investment, because I really don't think people even talk about this enough at all, especially bridging that gap between both types of real estate investment, whereas most people don't realize that there are different types that exist. So thanks for your insights. And to all our listeners out there, if you found value in our episodes, subscribe to the channel, leave us reviews, and of course, make sure you tune into our next episodes moving forward. And Arn, can you give everyone your contact info where they can reach you in order to partner up and get more information about what you're doing?
Yeah, thank you, Robert. So I'm very active on LinkedIn and Facebook, either under Arn Cenedella or Spark Investment Group. Website is investwithspark.com. No spaces, no dots, investwithspark.com. Lots of information there, educational, about syndications and so forth.
Absolutely. Well, I appreciate it, Arn. Again, thank you for your time. And to all our listeners, we'll see you on the next episode. Take care.